Well, LTIMindtree is down over 10% in the trading session. We have with us Mr. Sudhir Chaturvedi, the President and Executive Board Member at LTIMindtree, to talk to us about the way forward. Sudhir, hi, good to be speaking with you. Q3 was weaker than expected, but are you seeing any signs of recovery as we head into Q4?
We've had 3.5% growth year on year, a 0.8% sequential growth this quarter. When we look at the metrics, I think we're pleased with our order intake of $1.5 billion, and frankly, that's what we are mostly focused on. We have a strong pipeline of large deals. The large deal pipeline itself is $4.7 billion. So our focus is really on converting that for mid to long-term growth. In the short term, we are seeing pressure from furloughs. The furloughs were deeper and wider than expected. Verticals that normally did not have furloughs also had furloughs in this quarter. And some of these furloughs are continuing into Q4, which is why we have said that our Q4 will be in line with Q3. But as I said, the focus is really on securing mid to long-term growth by fundamentally essentially ensuring that the order intake is strong for a multi-year growth path ahead.
No, I take your point as far as order inflow is concerned, but that order inflow needs to convert into revenue as well, right? That's what the street looks out for. Any improvement in the execution rate or the conversion rate then?
The thing is what you need to balance, order inflow that is we are getting. The order inflow that we are getting are multi-year cost takeout deals. So these are, typically 3, 5, 7-year deals. And they tend to have, a slower ramp up because there is a transition involved from usually an existing provider, or the client is sometimes doing this for the first time. So there's transition from internal teams. So it takes longer to ramp up the cost takeout deals. Transformation deals tend to ramp up more immediately because the need for the business is more immediate. So our business at LTIMindtree had a high discretionary spend element, which is now being replaced by this, cost takeout large multi-year deal element. So I think in the longer run, this is more secure and secular revenue trends. It also gives us more avenues to drive margin expansion. So I would say that our portfolio of revenues is rebalancing in a way that is better, holds better promise for the multi-year growth path that I was talking about. And really that's what it is. The only other point I'll call out is that banking, financial services, and insurance, which is our largest vertical, has seen some pressure this year. We expect that pressure will start to ease towards the middle of next year. So I think the way I'm talking about the calendar year here. So the way we are seeing it is, a combination of, there are other verticals are already positive Y-on-Y growth. So we'll see broad-based vertical growth as well as, deal ramp-ups as we continue to win these deals. I think what's very pleasing is our win ratio on these deals is very strong. So as we continue to win this, that gives us the path to growth in the future years.
Okay, point taken. So BFSI is expected to pick up in a couple of quarters, and that is when we'll see growth come back. But you also talked about client budgets in your call yesterday, and what really stood out to me was the fact where you said that the client budgets are either flat to a potential decline. Talk to me a bit more about that.
Yes, I think, we continue to see caution in the environment. Clients that we have spoken with across the board are still talking about, keeping budgets flat to slightly negative. They're still looking to drive cost efficiency. So the main driver for clients right now, post-pandemic, the main driver was transformation. Currently, the main driver is cost reduction. And till the market environment improves, till we see essentially a reduction in interest rates and more certainty in the political environment, I think clients will continue to be cautious about their budgets.
Sudhir, the margins, we looked at the margins and they continue to slip as far as the company is concerned. Earlier, EBIT margin target was 17 to 18%. Now it has been pushed a bit lower. When do you see, this hit actually happening?
The ambition, the aspiration to get to 17 to 18% remains. That's a clear target that we have in mind. We said that we've pushed it out by a few quarters. The way to look at this is that, as we're seeing a strong pipeline currently, the intention for the business is to invest in creating capacity so that we're able to service the the growth that we're seeing and the demand that we're seeing. We also would think that there will be some short cycle demand that will start to come in the next calendar year. And short cycle demand needs rapid response in terms of being able to staff those opportunities. So which is why we are saying that we will invest in terms of adding capacity to the workforce, and therefore that's going to be our main focus to get growth back to the table, and then get growth to drive the margin expansion. As I said, combination of both the large deals that we have signed and the levers that large deals provide for margin expansion, as well as getting some of the shorter term growth also back. That combination will drive margin expansion. So essentially margin expansion through growth, but that will take will push out by a few quarters, is what we said in the conference call yesterday, and that's what we'll continue to do. I think the key thing is that we're still you're looking at we've maintained our margin performance in the 15 to 16% and continue to grow in this financial year. The fact is that the order book is the best indicator of where we will be in the future, and that is strong.
So the analysts say that there has not been enough evidence of either revenue or cost synergies with the merger so far. What would your reaction be?
No, I think when it's been a year since the merger, so we're still working through many of the synergies. We initially the entire intention was to bring the two organizations together in a seamless manner. We have integrated. In fact, I think we've integrated processes, systems, and people in record time. And our client satisfaction index is very, very strong right now. In fact, our recent CSAT survey, even the one that we did post the merger, showed that our client satisfaction was at an all-time high. So the key thing was to make sure that there was zero disruption to the business, that the clients continued to receive outstanding services from LTIMindtree, and we integrated processes, systems, and people. So we've achieved all of that, and the synergies will come. The first priority was to bring the two organizations together seamlessly.
Sure, would love to hear a bit more in terms of your synergies, in terms of what the exact numbers are. But shifting focus to calendar year 24 then, because we started off FY24 with the expectation that there'll be a double-digit growth. That was scaled down by the management last quarter. But now, do you think the double-digit growth is possible in FY25? And I ask you that because a lot of your peers are talking about a pent-up demand that might come through. Your take?
Yeah, I think calendar year 24, that we are in, which most of our clients have a calendar year budgeting cycle. We continue to see caution. There is caution from a macro perspective. There is still, geopolitical uncertainty going on. There are incidents in the Middle East almost every day. The war in Russia and Ukraine continues. There are issues that continue to be there. So clients are circumspect. Also, calendar year 24 is going to be a major election year for some of our key geographies that we operate in, the US, India, UK, and France. So I think that also leads to some level of political uncertainty. So our clients that are operating in these regions, I believe, will continue to be circumspect, cautious in calendar year 24. Thereafter, as there is more clarity and, as things settle down, I think we should start to see back, clients looking to get back on their transformation journeys and driving, differentiated growth for themselves towards the latter half of calendar year 24, as there's, assuming there is more certainty in the environment.
Okay, expect recovery only in the later half of calendar year 24. On that note, Sudhir, we'll let you go. Thanks so much for making time and speaking with us.